Hey, I'm sure you heard about the congressional $2 trillion stimulus package that has been launched in response to the coronavirus. Well, today I'm here to talk to you a little bit about how that's going to impact you as a home buyer, someone that has a mortgage, and someone that might be looking at buying a house. So what's going on in the mortgage markets, and why aren't we seeing much lower interest rates? So first of all, the mortgage market has been impacted by a perfect storm, and it's nothing like this has ever happened before. So there's a lot of guesswork involved, but then there's a lot of economists that have done deep studies on this and tried to figure out how we can turn things around in the mortgage market. So traditionally, when the Fed drops the borrowing rate to almost zero, mortgage rates tend to fall as well, and they should be at historically low values right now, but they're not. And the reason being is because of liquidity. Liquidity in the mortgage market is how we, as lenders, fund loans. And we're working on warehouse lines where lenders use a short-term borrowing to fund a loan, and then they sell the securities, and then they get their money back, and then they make their next loan. So what's happening right now with a lot of the mortgage companies is that the warehouse lenders are calling their lines, are putting tighter restrictions on their lines because they're afraid that some of these companies will fail. And the reason that they might fail is because of the liquidity in the market. So when the Fed is supporting the market with the stimulus package, by buying mortgage-backed securities, because no one was buying them before. Traditionally, when people get out of the stock market like they do right now, they'll go into the bond market, which is a secure and safe haven for investors. But they're not doing that. They're putting their money in cash, and there's not a lot of cash in the market. So when a lender's warehouse line dries up, or when they have margin calls, which means a margin call is when the investor needs to put more money in cash in case they were to falter into their cash reserves. A lot of companies, such as the big ones out there, Quicken is one of the big ones that are out there, is having some issues with the margin call at the moment. When they have to inject millions and millions of dollars into their reserves, they don't have as much money to lend. So that's the one reason why mortgage rates are going so high. The other is volume. There's just so much volume in the marketplace right now with purchases and refinances that lenders just can't keep up. Combine that with the coronavirus and the stay-at-home work order, many lenders were not ready for that, were not prepared for that. So they're taking 60 to 90 days to close a loan, and when that happens, they're having to inject more money into keeping that rate. So it's just been a very difficult situation for many lenders. It'll all be okay, I think, with the stimulus package, and the Fed is really looking at ways to ease up the margins so that lenders will still be able to lend and at a more affordable rate. So right now, if you are a government buyer and you're looking at a government loan, FHA, VA, or USDA, you may have noticed when you've talked to your lenders that you can get a decent rate, but you're going to have to pay up to sometimes 5 discount points just to secure a decent rate. Now, that's a very costly way of getting the interest rate, but it could be about the only way you could get a mortgage. So oftentimes the only way to move forward with that is getting the sellers to pay some of these discount points for you so that you can get a decent rate, you can afford to buy the house. The seller still gets their house, but they're helping you buy down the interest rate to a more affordable rate. That's happening across the board with many lenders because they're not wanting to make government loans. And why aren't they wanting to make government loans? Well, it's because currently in the marketplace, when a lender makes a government-backed loan, such as FHA, VA, USDA, if the borrower does not make their payments, the lender has to pay into the Ginnie Mae, or pay the Ginnie Mae, which is the end investor for these, make those payments for them. So if you're a servicer, you're sending out monthly payments or statements to your customers, and your customers aren't making those payments for those government loans, you're required to pay those. So when you're sitting on $1 billion worth of USDA loans, that could be a very large monthly bill that you have to pay, and you could quickly run out of cash. So lenders don't want to take on riskier government loans with higher default rates. So that's why you're seeing these much higher discount points or upfront cost involved with them, so that the lenders would be able to afford to make those loans. So with that said, many lenders have either stopped making FHA and USDA and VA loans altogether, or they're imposing higher credit qualifiers or overlays to their loans. And that would be some lenders have cut back the lending threshold to a 620, a 640, and some are even cutting them back to a 680. So we at Service First Mortgage are well secured in our finances, and we have made the decision to support our local community and to continue making loans down to 580, again at Service First Mortgage. Now, we are going to put some qualifiers on those as well that are not on normal FHA loans, and that would be that we are going to require you to have some monthly reserves into your before you close on the loan, that you're not getting a gift, that you're not seeing a huge payment shock, you've had payment history, you're not doing job changes, things like that. We're just imposing those so that we can continue to support those lower credit score borrowers and still be able to make them and remain financially secure. Other things that are going on is that you're hearing all over the internet, if you lose your job, you don't have to make your mortgage payment. Well, that's a very qualified statement. So FHA and conventional FHA or Freddie Mac and Fannie Mae have all three posted that they are allowing a 360-day forbearance option for customers that may suffer financial loss in regards to the coronavirus. So, but what that really means is that they're agreeing not to foreclose on those borrowers that are going to suffer from this for 360 days, and that you would have the opportunity to move your payments from when they're due now till later on in the loan process, either, depending upon the loan, at the end of 12 months or moving it to the end of your mortgage. If you have a portfolio loan, you may not even have this option. But what does a forbearance mean? A forbearance essentially means that you have the agreement with a lender, and you have to call and talk to your lender and tell them that you're having trouble and you can't make the payments. So they will agree to not foreclose on you for a period of 12 months. And all those payments, all the interest and everything will be tacked onto the back end of your loan, making you pay more interest. And they will not going to report you as being delinquent during this forbearance period. However, if you are unable to catch those payments up, then they can, after the end of the 12 months, they could possibly foreclose on you depending upon how your agreement is written. So read your forbearance agreement very carefully. Always call your lender first and get a agreement to not to have to make your monthly payments before you stop making those payments. Communication is going to be key here. So if you have any questions on anything that I've gone over and anything that I can address for you, please just feel free to give me a call, and I'll be happy to go over it with you and answer any questions that you might have. If you have great credit, you're still seeing interest rates in the low threes, so it's still a good time to refinance or purchase if you have great credit, and we would love to talk to you about that. Again, my name is Richard Woodward with Service First Mortgage. You can call me at 214-945-1066. or make a comment below in the comments section, private message me, email me. There's a number of ways you can reach me, and I'm here to help you any way I possibly can. Thanks so much. Have a great day. Stay safe, and call me if you need me.